From that very first candlestick that prints at the beginning of the week, everything is planned, timed, and measured. Whether you know it or not, there's a grand scheme to things, and if you can begin to pick up on some of these blueprints, you can greatly benefit from them. Ladies and gentlemen, in this video, I'm going to not only give you some of these blueprints and how to trade them, but also some rules and characteristics that go along with the opening range so you can rapidly progress in your trading careers. What is the opening range? To put it simply, the opening range is the first high and low in price in any given trading period. That applies to the year, month, day, or session. Down here, this is a daily chart, and this is the first month in the year. January is marked off, and you can see how price has behaved around it. This is for the week. We have Monday. That is the first day within the week. High and low of Monday creates the opening range for the week. I also have, for the day, the Asian session. That is the first session within the day, and that will create the opening range for the day. Before we continue, there are just some little itty-bitty details that need to be gone over so that the rest of this video can make sense. The market only does three things, and if we were to break it all the way down to just the smallest time frame, a 1 minute candlestick. A 1 minute candlestick forms, okay, and that's going to create a range. From that one candlestick, the next candlestick is going to open, and it's either going to break out and trend to the upside. It's going to break out to one side and reverse, or it's just going to stay within that one minute candlestick. Now, if we were to expand to a larger time frame, let's say the 15 minute, and we were to look at over the period of an entire week, we can apply those same concepts to the rest of the market. If we have Monday, and that creates the opening range for the week, the market can then only stay within that range. It can break out, pull back, and begin to trend, or it can break out and then fail, causing a reversal. Why does the opening range matter? I've got number one, we just talked about it, and we can form trading ideas based off of what I just said. Number two, it helps you identify where volume is trapped within the week. And number three, it can help to identify parabolic 3-day trading setups on Wednesdays and on Fridays. Some tips and tricks revolving around the weekly templates and the opening range. Now, I broke one of my own rules and I put way too many words on this slide, but I promise you, if you bear with me, it's going to be relevant. Number one, the market closed outside the opening range on Tuesday. The probability of Wednesday's continuation goes up significantly. So if we have an opening range and we have an opening range breakout on Tuesday and it closes on the outside, the probability of Wednesday turning into a parabolic trend trade goes up significantly. We could do a range expansion of the opening range and do 3 levels of rise. Now, here is where there's kind of a, if this, then this kind of scenario. One, market structure is going to help you to frame Wednesday with these opening range breakouts. But if Wednesday were to fail, there's another scenario. And I'm going to show you some examples of that as well. Number two, the market has closed as a failed breakout on Tuesday. So let's say that the market went out of range, went out of the opening range, and then it closed back on the inside of the opening range on Tuesday. That would basically give you a day one in the 3-day cycle, but that gives you an opening range breakout failure, and the probability of going from one end of the range back down towards the other end of that range on Wednesday goes up significantly. If Monday's breakout fails and then Tuesday's breakout fails at the other end of the week, high potential for parabolic trend trade on Wednesday. What this is saying is that if there is a peak formation on Monday, and then you have a peak formation form on Tuesday at the other end of the range, the probability of a parabolic trend trade on Wednesday goes up significantly. Number four, if Tuesday hits both sides of the range, of the opening range, the potential for a parabolic trend trade increases. This is just another scenario or another potential blueprint pattern that can occur. Another blueprint pattern that can occur, number five, 3 drives out of the opening range coming into Friday. And I'm going to show you, of course, a lot of these examples. That gives the highest probability for a reversal. If there are only 2 drives out of the opening range coming into Friday, there's a high probability of a parabolic trend trade to provide that third push in your session. If a breakout on Tuesday closes 3 levels of rise or fall out of the opening range, the potential for reversal throughout the week increases. And I will show you exactly what I'm talking about again with pictures. Here are some opening range and weekly template considerations. I want to emphasize that I'm only looking for two presentations of price: a parabolic trend trade or a long squeeze or a short squeeze. This is considered a short squeeze. They've made a higher high and they're pulling back in 3 pushes coming into my session. That is a short squeeze. If you flip this over, you would then have a long squeeze, and I will be talking about parabolic trend trades a little bit later. Market structure plays a massive role in identifying the trades, just like we have over here. Making higher highs, 3 pushes back down, and the move back up. We're going with the trend. If a new high low was made the day prior, is the market pulling back in 3 pushes? So, we have a previous day's high over here. Maybe this was the new day and we broke out, and now we're pulling back on the current day in 3 pushes coming into a session. If there has been a break in structure in the opposite direction, is the market now pulling back in 3 pushes for the continuation in your session? So maybe this is not an uptrend. Maybe we're actually in an uptrend and we've actually broken to the downside and are pulling back up into the high for a continuation, basically giving us a reversal. Look for 3 drives out of consolidation, 3 drives out of the opening range, 3 drives out of the previous day's high and low. Super, super important. And also, these are high tier setups. These are high quality setups based off of the weekly template. These are the trades that you want to be taking throughout your week. Your risk to reward should be no less than 1 to 4. It should actually be greater than 1 to 4 if your entries are on the 1-minute chart. So now I'm going to get into a bunch of examples. And I think that as I go through them, you're going to start to see how you can start to frame ideas around market structure, the weekly templates, the opening range, and if you can continue to go back in your own charts and find all of these examples, there's only so many things the market can do throughout the week. Here's the opening range for Monday. On Tuesday, they broke out and then they went 3 levels of rise. They also broke down within the minor structure. Over the course of the week, we have 1 push down, the 2nd level down, and a 3rd level down. They actually come out of the previous day's low in a 1, 2, 3 reversal on Friday. So this was a breakout, and over the course of the entire week, pull back down to the opening range for the continuation on Friday. So you might remember me saying that if we close on the outside on Tuesday, the probability of continuation goes up. But here's the thing. If market structure says market go up, then don't try and fight it. If we're making higher highs and higher lows and the breakout fails, then the probability that there's volume trapped at the low of the current week goes up, and we could actually be going towards the other end of the range for a breakout to the other side. In this case, we had a breakout. The breakout failed, and we actually did break out on this Wednesday in a parabolic short squeeze opportunity. Why is it a parabolic short squeeze? We've made a higher high, and we've come back in 3 pushes coming into a session or around the 9:30 time frame for the long continuation. Maybe you missed that. Maybe, Wednesday just didn't work out for you. Let's take a look at Thursday and Friday. From the low of the week to the high of the week, we have 3 levels of rise. That is 300 pips, 3 levels of 100. Now notice how they come out of consolidation at this level. They come out in 1 drive, a 2nd drive, and a 3rd drive to the high of the week, giving us those 3 levels of rise. And then they actually broke down on the following day, confirming to us that the probability of them reversing or having some kind of reversal from the high of the week goes up. We have 3 levels of rise, 3 pushes out of consolidation, a break in market structure. We're up high on a Friday where we're searching already for volume trapped. This is a perfect opportunity. Another really great template. As I said, you're looking for 3 drives out of the opening range. How do I identify those 3 drives? I use the previous day's high and low. The lowest point within the day will create a new previous day's low on the next day, and that just gives me a new level to come out of. Here's the opening range. This was the previous day's low. Obviously, that's Monday's low. So when we came out of this low, I created the first push. Once we came out again, I received the second push and a third push, just very slight, back down. We had a break in structure to the upside. This is the first mouse, meaning the first higher high that was formed. And a lot of times what will happen after those first higher highs is the market's going to go back down to stop out the poor soul who tried to trade the breakout. Maybe their stops are at the low of the day. Maybe their stops are somewhere up through these swings. But if you're trying to trade breakouts, 80% of breakouts fail, and a lot of times they'll go back down and put a lot of pain into those people. Notice that they have now broke structure to the downside on the 15-minute chart. I think there was news here. And then there was a 1 drive, 2 drive, and 3 drive on the 15-minute chart. On the 1-minute chart, after this break in structure to the downside, before they even started pumping, I would be on the 1-minute chart watching for a pump and dump as the market is going up. I would wait for the 1-minute chart to then break structure to the downside, give me 3 pushes back up into the high on the 1-minute chart with an engulfment, and that would be my entry. From the last example, which Monday was also an inside day, and coming into this example, Monday is also an inside day. And I have found that when Monday is an inside day, the weekly templates seem to be more volatile, because after an inside day and they break out something like this, you would normally expect them, if the breakout fails, to go back at a minimum to the other end of that inside bar to stop out the traders who tried to trade the breakout. But a lot of times this will lead to larger moves within the weekly template. And just like the last pair or the last slide, 1 drive out of consolidation coming into Wednesday, 2nd drive, 3rd drive, and the breakout failing on the next day. So they broke out, 3rd push on a Thursday, coming into Friday, break in market structure, and a large scale reversal on Friday, leaving the trap volume at the high of the week, all the way back down to the opening range. This is a really great pump and dump example within just one weekly template. We're already in a broken down market from the week before, and it starts to pump up on Monday. Monday creates the opening range. On Tuesday, they break out. And on Wednesday, we actually get a first red day where they spiked the high, they spiked lower, actually breaking structure to the downside, creating peak formation high, peak formation low. After you get a lower low in the market, you would typically look for 3 pushes back up. And they give you a beautiful stair step 1, stair step 2, stair step 3, New York session dump from high of day all the way down through the low of the day. Opening range has now failed at the high of the week, pump and dump, and on Friday, continuation down through the opening range low. One more quick little note with this example is that when they came out of consolidation, this previous day's low on this Friday, notice how they did it. 1 drive, draw your line. 2 drive, draw your line. 3 drive, reversal on a Friday, leaving all of these people trapped at the low of the current week. Here is another 3 drives out of consolidation template. We have the opening range, which was also known as inside day. Breakout 1, breakout 2, breakout 3. This was Thursday, so we have 3 breakouts coming into a Friday, and they drop it down 1 level, they drop it down a 2nd level, and a 3rd. And there's like a little inverse head and shoulders at the low of the day for the large scale reversal back up on a Friday. Tuesday, in this instance, closed outside of the opening range, which means the probability of a continuation on Wednesday goes up. They've made a lower low, and here we are with the continuation. Now, after giving you some larger all the way through the week scenarios, I'm going to show you how to just hone in on only 3 days: Monday, Tuesday, and Wednesday. Monday scenarios. Inside day. Tuesday breaks out. We have a peak formation low, which is simply just a swing low. This was the swing low. They made a higher high, so now we have a swing low. Peak formation high, peak formation low. This is a peak formation because it's simply a swing high. And then we get a break-in structure to the downside, looking for a lower high. And we get our only 2 patterns that I'm looking for, parabolic trend trade back down on a Wednesday. That means that the opening range has failed and gone into a parabolic or capitulating channel on a Wednesday, which is the day that you're looking for this pattern, with peaks and a midweek reversal back down. In this example here, you can see on Tuesday we have broken out of the opening range, giving us our first push up. Draw your line. Now we have our second push up within that same day, and then a third push up on Wednesday, again for a midweek reversal. We have a midweek continuation. This was a little too early. It was outside of the session. This candle right here, followed by this candle, is, I believe, 9 o'clock for a midweek reversal. Here is another example. We have Monday. Tuesday was actually the inside day. On Wednesday, we have 1 push out of the opening range, 2 pushes out of the opening range, 3 pushes out of the opening range. First bar entry, 8 o'clock for a midweek reversal. Talked a lot about midweek reversals, but this is more of an example of breakout, pullback, continuation on a Wednesday. Monday, Tuesday, Wednesday. Tuesday was an inside day. Wednesday has now broke out in 1 push, 2 push, 3 push right at the beginning of the day and started to pull back coming into the New York session. And they're driving and they're working the top of the opening range instead of failing and coming back inside of the opening range. Goes vertical on the news. There's probably a news trade in there or whatnot. Again, makes a higher high, comes down, and puts in a base right on top of that opening range. Now, although I will be making a completely separate video for the day zero trading setup, it does tie in greatly to weekly templates. So I wanted to include it in this video. Day zero has nothing to do with the 3-day cycle. Nothing. Okay, so completely remove that from your brains. Day zero is simply a pattern. It is a trading setup on its own. In one day, you're going to find that the market is going to peak high, peak low very violently, and then pull back inside of those peaks. So within that range. A lot of times it will hit both sides of the previous day's high and low in one day. And you're looking for a parabolic short squeeze or a parabolic trend trade on the following day. This is a low of week or a high of week setup. So I want you to notice peak high, it spikes the high, spikes the low, pulled back inside. It's made a higher high, break in structure, and then pulled back 3 pushes into a session, into the New York Open vertical move. This is a short squeeze from the low of the week on a Wednesday. Perfect opportunity. Day zero trading setup. Here's another example of a day zero where they've spiked the high of the previous day's high. They spiked the low, previous day's low. And I've drawn the market structure out for you. Lower lows, lower high, lower low, higher high. Look for 3 pushes. 1, 2, 3. W at the low of the day, right at the London session. Ladies and gentlemen, I really do hope you've enjoyed this video. If you have, please do me a favor, hit that like button. If you haven't already, subscribe to the channel. You have a wonderful day.